All right, so we've put together the aggregate demand, aggregate supply model in terms of inflation gaps and output gaps. Now what we're going to look at is demand shocks, which these are the drivers of the expansion and contraction of the business cycle. So let's take this by going through some particular examples. Suppose there's a global pandemic which results in a strict lockdown paired with social distancing. Real output growth and velocity of money continue to drop as consumers begin to save more. Again, savings in this case defined as not consuming. As these consumers save more, firms get less revenue. Firms lay off workers, decrease wages, income drops. Consumers begin to consume even less. So we have our growth in the C plus I plus G plus NX equation, right? Beginning to go down in terms of also that output, and that's caused by that velocity shock. Less money changing hands around the economy. So aggregate demand falls, resulting in disinflation. Here we have lower levels of inflation, lower than that inflation, target inflation gap than we would want. And then we would also have lower output relative to that gap that we want, that output gap that we are targeting. So the Federal Reserve and the federal government then would have some incentive to try and find some way to push this aggregate demand back out. Okay, well, let's take a look at the other case. Let's say a boom or an expansion. So let's say there's an unexpected stock market boom, increases returns in nearly everybody's portfolio. We begin to spend more because we feel wealthier. So growth in consumption, investment spending, that all begins to increase. Our output increases from that velocity of money shock that we have, more money changing hands. And what we end up with is a higher rate of inflation, higher relative to that inflation gap in the short run anyway. And we also have a higher relative output gap then that we then benefit from. So more hiring, more wage increases, more revenue to firms, all those benefits you get from that rising output and rising prices. Now, if we take a look at this then as we go from the short run into the long run, what's going to happen there? So we have this, instead of say a velocity shock, let's say we have a money supply shock, and let's say that money supply shock is permanent. Let's say the Federal Reserve is just, for whatever reason, pumping out money into the economy, and it maintains a higher growth rate of money supply than it normally has. Well, in that case, this inflation gap will rise to a new long-run stable level. So it will be stable. I mean, we could get price stability as the Federal Reserve wants in its mandate, but it would be a higher inflation rate, not only relative to our initial long-run point, but relative to our short-run point. This output, of course, is going to fall back to that trend level of potential output that we have here, because remember, those are related to actual productivity shocks as opposed to monetary shocks. And so we'll see this higher inflation rate. Firms will adjust their expectations. They'll begin to write contracts based on a 4% inflation rate or 5% inflation rate, as opposed to, say, the 2% Federal Reserve target. So that, if we maintain that kind of expansionary policy, we will end up in the long run with just inflation and no aggregate output benefit. But we do get a benefit in the short run. Now, if it is a velocity shock, it's considered to be a more transitory shock, and we'll end up having this aggregate demand curve here. So we're going back to say this, potential shock. Let's say it's that velocity shock going on instead of a money shock. And here we have that aggregate demand curve settling back in the long run to our trend output growth. We no longer have this kind of monetary illusion from that velocity shock. All right, so that's how these expansions and contractions work in the Keynesian model, and we'll move on to how fiscal and monetary policy respond to these in the last two easy pieces of macroeconomics.